Hey, welcome back. Good morning. Happy Monday to everyone. And I hope I'm going to get back in the routine of putting these videos on after my harrowing ordeal there in the Marquesas Keys. But I appreciate all of you understanding. But this video comes to us from a request from one of our traders in this group. And he was asking, what is the max pain indicator? And this is one you're starting to hear more about. I'm not sure why, but it's starting to pop up in a number of areas. But I have a suspicion it's because people are always looking for an easy way out. What's the easy way to predict the market? And they come up with these really unbelievably bad ideas. This could really go into our idiotic ideas videos. But they come up with these just really bad ideas, but it sounds good on paper. And then everybody starts to follow it. And I can tell you that if you follow this, if you're basing decisions on the max pain indicator, you are going to get yourself hurt. If there are any instances where it appears to work, that's probably for far other reasons than the idea behind the max pain indicator. But as always, doesn't hurt to go take a look and find out what it's about and why it's a bad idea. And if you hear about it, at least you'll understand what it is and how it's calculated. A little bit of a tedious calculation, so we'll take a look at that. So let's jump in. Let's have a closer look at what is the max pain indicator. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So max pain, well, it's a type of stock market predictor. Where is the Dow going to go? Where is NVIDIA going to go? Pick your underlying. You can apply the max pain indicator. And essentially what it is, you're just finding a point where the maximum number of options will expire worthless. And they will weight this by the open interest. That'll make more sense in a moment. Now, one thing that's interesting, it's very similar to the pin pressure indicator. And really the ideas behind it are essentially the same, but it's still trying to do the same thing, trying to find out where the markets might head. The idea behind the max pain is that the sellers are really in control. And that right there is just an absurd assumption. But the idea is that the sellers will try to push markets towards this level of maximum pain being the biggest dollars lost, to get the buyers to close. So remember that buyers of options have limited risk, unlimited rewards. The sellers are on the opposite side. So they have unlimited potential risks and limited rewards. So sure, on paper, you can see why it would make sense to say, oh, I'll bet all of these big players out here are going to conspire to push the markets down and get everybody to close their options so they can make the maximum amount of money. But again, we're right back into this idea that even a handful of people would be powerful enough to manipulate the markets. Now, also keep in mind, for anybody who still is inclined to believe that, it's not without risk. If Goldman Sachs wants to come in and just short tens of millions of shares to push the price down, remember, they're short. And if something happens that causes the markets to spike, it's not without risk. So this whole idea that somebody can just take prices up and down at will is completely wrong. But that's really what this whole theory rests on. So to make more sense of it, let's jump over to an Excel spreadsheet and take a look at the calculations of the max pain indicator. Okay, so now we're into an Excel spreadsheet, and I've just chosen the Dow. Let's say that these are some strikes. Now, in the real world, you would use every single strike, but just to make the example small and easy to understand, I'm going to go by 100-point increments, and I'm also not going to list all of the strikes. But for whichever expiration you're interested in, you would list all of those strikes. Now, also, there are lots of websites out there that will do this for you. You just type in the ticker symbol, and it's going to draw this little graph, which I'll explain here in a moment, and it will do it for you. But as always, I think it helps to understand the details of what you're looking at by going through the actual calculations. All right, so these are a list of strikes. Again, in the real world, you would list every single one for a particular expiration. Next, you will list the open interest for the puts at that strike, and you will list the open interest for the calls at that strike. Now, of course, this is going to change continuously. It's a dynamic system, so that's why it's a really tedious calculation, as you'll see, and that's why it helps to have some software do it for you. So what's going to happen here? Well, the idea is the calculations, again, are fairly easy. They're just very tedious. You got to just kind of keep your bearings. So for example, let's say that the market closes at 39.5. All right, so we're going to look at this strike. I'm just going to highlight those in red right here. So the market closes at 39.5. Think about the 39.5 strike for calls, 39.6, 39.7, and all the way up the line here will all expire worthless. So we have no in-the-money calls. So that's where that 0 is coming from. Now what about the puts? So here's what we would have to do. This is what the software is going to do for you. All right, so if the market's at 39.5, the 39.6 strike is in the money, right? We're not going to count the 39.5s because, again, they're at the money. They will expire worthless. But the 39.6s are 100 points in the money. The 39.7s are 200 points in the money. How many are at each of these? Well, we've got 44,256 at the 39.6 strike. We have 38,401 at the 39.7 strike, and so on. So here's what the calculator is going to do in the computer. We're going to say, let's just do this strike minus 39.5. All right, now 39.6 minus 39.5 is 100 points. We're saying we're 100 points in the money times this open interest. All right, so everybody with me. And we're going to copy this down. So it's just saying the 39.6 strike put would be 100 points in the money times 44,256 contracts. And that's what that number is right there. The 39.7 put is 200 points in the money times 38,401 open interest, and that's what that number is. So if we come down here and we say, take the sum of these, and if we did this right, we should get 283,648,900, and that's what that number is right there. Okay, so again, it's a little cumbersome, but just to reiterate, we're going to go through each of these rows and say, if the market closes at this number, how many calls are in the money and how many puts are in the money multiplied by their open interest. So again, we have 0 calls that are in the money, but we've got a value, let's say, 283.6 million. So if we add these two together, we get that number, 283.6 million. So it's basically saying that with this open interest, if there are 100 points in the money, that would be the value of those contracts. Now remember, that's the payoff. That's not what you paid for it. It's just showing the value of those options at that level. So let's go down to, let's say, at 40,000. All right, let's change these up here a bit just to make it easier to see. So let's make this 40,000. If the Dow closes at 40,000, what happens? Well, now all of these calls are in the money. The 40,000s are not because they're at the money. All of these puts are out of the money, but all of these puts are in the money. So remember, we're not going to count these in red because they're at the money. So if the market's at 40,000 and you've got the 39.5 calls, what are they worth? Well, let's do equals. It's going to be 40,000 minus 39.5, which is 500 points, times this open interest. And that's going to come up to be this number right here. Let's put a comma in there so we can see it, about 3.6 million. So remember, we're going to do that for each row up to, but not including 40,000. So now if we did this right, let's say equals sum, come up here, and we're going to get 14,077,000. And that's exactly what we got right there. All right, so that's where that number is coming from. That's the overall dollar value of the calls that are in the money. These are the guys that are going to be getting scared. They're the long positions. At least that's the theory. Now, what about the puts? Well, if the market closes at 40,000, remember that's always our assumption. We're going to assume that the market closes at each of these rows. So if the market closes at 40,000, all of these puts are out of the money, but all of these are in the money. So let's do the same calculation. What would they be worth? Let's say equals 40,100 minus 40,000, and we're going to multiply that by the put open interest. So that's going to tell us these would be 100 points in the money for 45,582 contracts. And if we copy that down, here is the total value of the dollars in these put options if the Dow closes at 40,000. So again, if we did this right, we should do sum, and let's bring this up, and we should get about 68.6 million. And that's what we got right here. Not sure why my commas didn't show up there, but anyway, that's the same number right there, 68,605,900. All right, so that's where that number is coming from. So they're just going to do this for every single strike price. They're just going to say how far is it in the money multiplied by the corresponding open interest. And then what we do, once we get it for the calls and puts, we take the totals. And if we plot these totals right there on a chart, this is what we get over here on the right. And so the theory is that where this number is the minimum, that's where the maximum pain occurs. So what they're saying is that where we have the least amount of profits, that's where this minimum number is coming from. In other words, if the Dow is way down here at 39.5, put options are loving it. Look at all the money that's being made. And if the Dow ramps up here to 40,700 or higher, look at all the money that's being made by the calls. They're not going to be scared, so to speak. But when we're getting close to this minimum value, that's where the long positions start to get scared and want to close things down. Again, it's an incredibly bad assumption. Because the other thing that I find interesting, if you talk to most traders, they'll say, oh, well, everybody knows that options expire worthless and you want to be the sellers. All right, well, if that's true, that would put the market makers and the big boys, so to speak, on the long side. Well, now they're saying that option traders are on the long side and all the big players are on the short side because they have the ability to manipulate the market. See, it just doesn't matter which side you take. Somebody always comes up with a theory that they say makes sense. And it's just a really bad idea to think that the entire reason for trading something is to say, okay, well, now we know that the Dow is going to get pushed to 40,200 because that's the area of maximum pain. And the big boys, the institutional players, are going to force it there. And if you believe that, you are certainly free to try and use the max pain indicator. But also, as I've talked about in many videos, remember, if everybody else knows this, then it gets factored into the prices. And you have to account for the prices before you can account for the value. So just be very careful about anybody who is telling you to use the max pain indicator. It's another one of these really bad ideas that for some traders will sound really good. But at any rate, if you at least hear the term max pain, you know what it is, you know what the calculations are, but hopefully, more importantly, you realize why you want to stay far away. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.